Howdy, folks. Welcome back to the StockCharts TV studio here in a cloudy but still warm, so we'll take it, Redmond, Washington. My name is Grayson Roze, Chief Strategist here at StockCharts.com. Delighted to be with you. I got to congratulate you for making it this far into the year. This has been a crazy, crazy year. Now, you might think if you went to sleep on January 1st and you woke up today, we got an S&P that's up about 7%, right? Seems like everything's been great. But the reality is the ride to get to this point in the year has been anything but easy. So today, we're going to dissect the first half of the year. We're going to talk a little bit about what we expect to happen in the second half of the year and beyond. And I brought on one of the best that can do it with me, Mr. David Keller. Dave, how are you?
Welcome
to the show. Thanks for being back in the studio.
Good to be here, as always.
Quite the year.
It has been.
Yeah, quite the year.
Yeah.
I mean, it's crazy to think about. We were talking about this a little bit before the show. Crazy to think about the ride that we've gone on, the absolute slammer of a sell-off, but now the rally back. We were talking about the 61 closes for the S&P 500 above the 20-day moving average off the lows. I mean, just an absolute ripper of a bull market after a ripper of a bear market there we had. So crazy, crazy year. I feel like this is one of those kind of check on your friends types of markets, right? So I got to ask you first and foremost, are you okay? Do you need a hug? Do you need to get a warm blanket, lie down in the corner? Are you doing okay?
I'm marking myself safe from the 2025 financial
we need
markets.
a check-in.
I feel like
the Facebook thing.
It's good. And honestly, I feel like years like this, which have had really tough periods and also really, really strong periods, but it's not felt good in a lot of ways, right? I mean, the downtrend didn't feel good. The uptrend at times has felt like the most hated bull market in history. So the good news is I think it's a great reminder of the importance of routines, the importance of consistency, the importance of focusing on the evidence, of analyzing trends, of not relying on emotions, but just relying on what's happening. So I think that it's been a great learning experience, and hopefully we can tease out some of those lessons along the way.
It definitely has been a fantastic learning experience. It's also pretty wild to compare Trump's first year in office to this first year of the second presidency here.
All right.
Remember his first year in office was just the snoozer of all snoozers, absolutely no volatility,
so
market
quiet.
did nothing.
Yeah.
We certainly haven't had that this year. It's been a little bit different. But I think you're absolutely right. It's definitely a time to learn. It's been that for all of us. We're going to get into a lot of those topics. I want to specifically touch on psychology, how you kind of handled the psychology side of trading and investing through this. Also want to get into how we're handling noise. I feel like this is the type of market where we just have so much noise surrounding everything we do. Before that, maybe let's kind of go back to the beginning of the year. I want to talk about kind of what your expectations were coming into this year. What did you think was going to happen in terms of kind of index and sector performance? What did you sort of expect to see from the markets this year?
Well, so if you think about the end of 2024 feels like 10 years ago in a lot of ways. I feel like we've all aged a lot in the first 6.5 months of this year. But I mean, if you go back to the end of 2024, I mean, the market overall was in a position of strength generally, right? And that we were making new highs. We made a new high in December. We made another new high, in kind of January, February, before what ended up being a pretty significant top. But I would say at the end of December, conditions pretty good. And so I think it was a lot of similarities from a technical perspective to what we see now, which is we came off a significant low. That was like August of 24. We had a really nice rally in the fourth quarter. And the question was sustainability, right? And how you follow those gains. And I think in an environment like then, very similar to now, when you have the market in a resilient uptrend, your two goals should be, number one, follow that uptrend as long as possible and maintain exposure, but always be looking for signs to be concerned about, right? Signs, warning signs, red flags that would tell you, all right, this last new high may not, may be the final one kind of thing. And so I think when you look back, the position of strength was pretty clear. I think it led into what happened in January and February. And if you look at a lot of the breadth conditions, momentum conditions, that February peak was a lot weaker than kind of December, right? So I think the end of the year was pretty good, pretty optimistic going into the new year. And then we started to see signs of weakness emerge in January, February. So I think the end of last year into the beginning of this year was almost a masterclass on following the trend, but having a very clear game plan for when that trend is changed. Because I think the moment it changed, there were a lot of good warnings in February and a lot of good warnings as we rotated lower. So I don't think you had to ride the market all the way down before there were clear kind of red flags that you shouldn't have missed.
Yeah. Are you looking more at kind of deep internals, breadth and sentiment and things like that? Are you looking at just pure price action on the indexes or sectors?
Yeah.
What kind of grabs your attention most in those kind of moments?
So I think a little of both, right? I think there's a balance between sort of the high level kind of top line performance, right? What is the chart doing? And this is where my son Henry, who's 9 now, yesterday I was getting ready for doing a video, and he literally came around the corner and started looking at one of the charts I was doing. It was a chart of the S&P, the NASDAQ, the Russell 2000, and he was like, well, that was started out pretty high, but then it really rotated lower. I'm like, dude, that's exactly what Daddy does all the time.
I love that.
So I think that just the very simple, like, look at the chart, should I be happy about this or should I be concerned? And just keeping it simple, I think is really important. And I think when we ignore that and get too focused on a narrative, that's when we can get into trouble, because that's when we make decisions not on what the market's doing, but on this sort of narrative that we're painting in our own brain.
Yeah.
But I think what I've also learned, from the end of last year to the beginning of this year, just a reminder of the importance of looking at market internals, looking at breadth, looking at momentum, and just qualifying what we're seeing with the major indexes.
Yeah.
So I think particularly in the first quarter of this year, there were a lot of signs of weakness that, looking back, were pretty straightforward, right? Market moving higher is good. The market moving higher on strong momentum is great. That's what we were like at the end of last year. Market moving higher on weaker momentum and weaker breadth.
Yeah. Those internals kind of
leadership starting to change, internals questionable. Like, that just tells you it's different, right? And we need to have a different way of characterizing that market. And so I think that I think this year has already provided a couple of really good historical bullet points in market history. Really important to go back and reflect on, what did I see at the top and what did I miss? What did I see at the bottom in April? What did I miss? And I hope investors make time to do that at some point.
Yeah, absolutely. It's interesting for me to think back on this year and into last year too, and even a little bit beyond into like 2023 and 2024.
Yeah.
To me, one of sort of my takeaways, if I'm writing down my notes from the first half of this year, we had so much optimism after Trump was elected for deregulation, more business-friendly environment. We had a lot of people saying this is going to be great for stocks, this is going to be great for business. The reality is, though, we were facing a time when in 2023 and 2024, the markets had 2 huge years back to back.
Yeah.
And I think that got lost in some of the optimism of Trump coming back into office.
Yeah.
People just kind of had their finger on the trigger, ready to sell the market, because they'd had these 2 huge years.
Yeah.
And so as soon as you see the market start to sell off, I think that was a huge factor in the sort of magnitude of the sell-off that we saw. People were just kind of ready to take some profits after 2 huge years in the markets.
Yeah.
After a bunch of challenging years that we also had.
Yeah.
So it wasn't just 2 big years after kind of a steady run higher.
Yeah.
It was 2 big years after just some crazy years through COVID and everything like that. So to me, that's kind of one of my takeaways from this year is, you got to look at the past. You got to bring some more context. Even just percentage moves on the indexes in years past can be enough context to say, if this market does start to sell off, maybe it's going to really, really start to sell off, not just because of the tariff news, but just because people are kind of ready for this thing to sell off.
And that's a really, really good point. And I often get critiqued, I would say, with content I put out, because when the market's making new highs, I'm definitely thinking more I have a bearish hat, and it's like, what would tell me that this is not going to go on anymore? And I think going back to thinking about what you just said, which is when the market's had such a run, you just know it's not going to go up forever. I mean, long term, the trend in the market is pretty good,
right? But
there are some painful drawdowns that we've experienced, and if there's one thing I've learned, just holding on and being optimistic as the market gets absolutely crushed is not great, and that's not a fun feeling. So trying to keep your losses small, kind of recognize when that picture changes.
Yeah.
And so the path matters, right? I mean, I think what happens up until today matters. And I think if we get too caught up into optimism because of what could be coming next, you could see that arguably now with valuations that are relatively high with a lot of technology stocks, right?
Yeah.
If you focus too much on that, you'll always be surprised by a pullback. but they're going to happen, right? I mean, corrections happen. Even in really good years, you usually have a couple really good pullbacks to deal with.
Yeah.
And so for me, I think that's exactly right. I think there was a relentless optimism at the end of last year.
So much.
A lot of optimism after the election. A lot of optimism about what 2025 to 2028 are going to be like.
Yeah.
And I think that was just setting up for a pretty significant drawdown, which we obviously
that to me was the slinky, right?
Yeah.
That slinky was just so stretched, and when it snapped back, it really snapped back.
Linda Raschke always talks about the rubber band effect, right?
Yeah,
Just thinking of, here's the kind of mean average thing, and when the rubber band gets stretched on either case, it's going to whip back pretty aggressively. We've seen that just this year for sure.
Absolutely. Mm-hmm. Now, you and I both look at tons of charts. We look at tons of data. We talk to a lot of other market strategists, technicians, investors, traders.
Yeah.
This is kind of one of those environments, especially when the market starts to sell off so aggressively like it did in the first half of the year. It's one of those times where we've got so much screaming at us, so much information, so much noise, and it all seems to conflict, right? And we're trying to figure out, exactly what's going on.
Yep.
I want to ask you, does your toolkit change at all when the market starts to sell off like that? Or is it kind of more of a buckle down, watch the action with the same charts, the same tools, the same kind of lens that I've been using? How does your toolkit evolve? Or on the flip side, how does it stay the same when we see the market start to sell off?
That's a really awesome question. So honestly, it's like a little of both. Yeah. I would say one thing I've learned, and honestly, StockCharts has become a pivotal part of this. For me, being a consistent investor means you need to have consistent processes, right? And you, I think, do a really good job of sharing your own structure as well, right? You have to have things that you do and that you do consistently. And so for me, it's every day, here's what I do. Every week, here's what I do. Every month, here's what I do. Every quarter, here's what I do. And that's what defines me as an investor. So, every month I do a monthly chart review where I'm looking at long-term charts and I'm just thinking about what I've learned in the last 4 weeks and think about what I'm expecting in the next 4 weeks. And I do that consistently, right? And so the set of charts I'm looking at are charts that I've refined over a number of years that I found if I just keep following these charts in this consistent way, I'm not going to be surprised by what's happening. And if something crazy happens, I will have kind of already thought that through because I have this structure. But I would say on the other side of that, there are things that can be more valuable at different parts of the cycle, right? So when we're in like early 2025 and we're heading, higher and higher, I have kind of a market top checklist that's in the back of my mind saying, all right, we've been up a lot. These are the things that have happened at other major peaks. These are the things I'm definitely going to be looking for. The Hindenburg Omen is one of those things. Like, you really, in a down market, you don't need it because the market's going down.
Right.
But in December of 2024, the Hindenburg Omen fired. And for me, that was like okay, we are looking very similar to the end of a big bull market phase. In the end, that ended up being a really good, sort of cautionary signal that things might get weak. When the market sells off aggressively, I have more of a market bottom checklist. It's all right, where do we find capitulation? What do we need to see to find stability? Things like the Kopic curve and other things are really, RSI oversold conditions. There are things that you really only use when you're trying to navigate a bottoming period.
Yeah.
So I think, and seasonality is another big part of that too, like where are we at in the 12-month cycle? So I think a good balance between the stuff you just look at consistently, forget about what's happening in the world around you. Here's my go-to, and I have a series of chart lists on StockCharts that I look at every day, every week, every month to do that.
Yeah.
But then there's also like these, sort of cyclical things. The market's in a good uptrend, the market's in a good downtrend. The market might be bottoming, the market's hitting a key level. There may be some, topical kind of thematic charts that I think are helpful. And I think remembering that there's that balance between the two, for me, has served me pretty well. Yeah. Does that make sense?
Yeah, no, I absolutely believe that. The consistent lens, but then sort of, letting things kind of be, moving in their weights, I guess, if you want to think about it that way. But that consistent lens is such an important part.
Huge. Yeah.
Through cycles, through years. You and I have been both doing this for so long. I think that the most important part of my system is the fact that it actually doesn't change very often.
Yeah, right.
People always look at this and they're like, I got this new chart, I got this new indicator, I got this new tool, and I'm sort of going, Great.
Don't need it.
I got my stuff. It's actually really nice. I'm looking at the same market charts through all of these different cycles.
Yes.
That consistency, that sort of repetition with that toolkit,
yes.
I think is what makes it really fly.
I'll tell you my favorite, if I can. My favorite story about this was before I went to Fidelity, this was like mid-2000s when I was still kind of learning technical analysis and getting my feet under me, I was big into reading anything I could about the new indicator, the negative. You're on this perpetual search for like the holy grail. Like your job as an investor is to keep looking, and eventually you'll find that thing, and it's like, okay, great, now I can relax.
Yeah.
And then I go up and I manage a team at Fidelity, and what struck me is some of these guys had been women had been analyzing these charts for decades with great success, and they were not doing this relentless search for the holy grail. They had their tools that they used, and they just did it like every day, every morning. I would find analyst A in the same room with the same pile of charts and the cup of coffee, and they're doing the same thing. And then the next morning, I'd see them do the same thing at like 7, 8, 10 a.m. And it was such a great reminder that the game, I need to think of my journey as an investor of less trying to find that one technical indicator, that one chart that's going to make it all easy. I need to find a set of pretty good tools and techniques, and then just do it, and just keep going back to that, and then improve on that and tweak it over time and evolve it. But just the consistency matters, and I think that is such a great reminder of. And again, I would encourage when people are using a platform like StockCharts, your goal should be setting things up in a good structure so that you can show up every day and kind of go through the steps you need to take, and less about just trying to find that one indicator. That is a fool's errand in so many ways. It's
a good time to mention for all of our viewers, we have a market summary chart pack, tracks with our market summary dashboard. It's all the charts really that I look at, so many of the charts that Dave looks at, kind of in that structure. It's organized into these different lists. Lots and lots of charts packed in there. But I would say if it's not in that list, you probably don't need it. If it's not in that chart pack, you probably don't need it. It's very exhaustive, but it's exactly what Dave is talking about. This sort of pre-created, pre-formatted collection of lists that you could put directly into your StockCharts account. If you sit with that every day, every week, every month, it is an incredibly powerful sort of consistent lens that you can use to follow really every corner of the markets. But you can make it your own, you can customize it, but again, that framework, just like you're saying, that sort of structure, that is what makes that thing absolutely fly. So definitely, we'll put a link down in the description below of this video. Definitely check out that market summary chart pack if you haven't already. It's a great time to mention it. I was thinking as you were talking there, since we're in Seattle, Amazon country, right? There was an old story about the way that Jeff Bezos would run meetings and the way that he would run teams. And his whole thing was 70%. Percentage might have shifted around over time, but his whole thing that he would tell people is, I want to get 70% of the information that we can, and then we're going to make a decision. We are never going to get that extra 30%. We're never going to know that last 30% to get to absolute perfection. We got all the data we need. We got everything that we need to know to make a decision. He said, it's a fool's errand. You're never going to get that last 30%. If you can get 70% of the information that you think you can gather, you have enough to make a decision. You got to make a decision, move forward, and then react to whatever happens. It is like the best trading and sort of market analysis lesson that you can come up with. You're never going to know absolutely everything out there about the market. There's always going to be more data. There's always going to be another chart. There's always going to be another indicator. And so getting yourself to kind of say, I know enough to come to a conclusion and to take an action, I think that's absolutely crucial. This year is a perfect example. So much uncertainty, so much noise. If you just kind of said, I'm going to get to the point where I feel like I know enough to make a decision and to move on, that's a powerful lesson.
100%.
It really is.
And I think the other important, side comment on that is the signal versus the noise. I mean, I think there's so much noise when you're trying to make sense of the markets, and so many competing narratives, so many things to listen to or watch and read, and it can be very paralyzing, right? You get the analysis paralysis, and so I think
that's where that consistent lens comes in.
100%. And so if you have it more clearly defined and you just kind of go through that process consistently, I think that can be quite helpful. But for me, a lot of times in an environment like this that's been very frustrating and challenging at times, almost taking a step back and trying to like reduce the number of inputs you're using as opposed to adding, in a lot of ways can be very, very helpful. I mean, I feel like in a lot of ways, if you just simplify, if you look back at 2025, a really simple lens, and just think about, moving averages or trend lines, like if you just draw some simple things, it's not hard to kind of lay out, okay, this is what happened, and this is when it shifted, So I feel like using this as an opportunity to kind of, simplify a little bit and get rid of the noisy stuff and just focus on what really helped you navigate a period like this. That's going to help you be better prepared the next time.
It absolutely is.
Yep.
I think we're going to jump over to one chart because we got to touch on how crazy this year was. So we'll jump over to StockCharts here really quick. I want to point out how wild this year was, just to kind of relive it here for a sec. So here's the S&P 500, right? We have a very simple chart. All we have is the 200-day moving average and some candlesticks on here. But at the very top, we have a one-period rate of change indicator. Now, if you're not familiar with kind of why we do that, this basically shows you single-day percentage moves using the single-day, one-period rate of change indicator. So what we can use this to see is how crazy these percentage moves were off the lows. Now, of course, if we have our inspect tool turned on here on the workbench, we can also hover over any of these candles and see those percentage moves. But the rate of change indicator gives us kind of a really unique way to see it. And specifically, we can zoom out, as we're going to do in just a second, see that. You can see how huge these were, though. I mean, down almost 6% on the day, and then 2 days later, we had a 10.5% rally on the S&P 500. Just absolute madness. We've got some charts later that I want to pull up because they really have just stuck with me, kind of zeroing in on exactly what was happening in those 3 sessions. But specifically what I want to do is step back and show you how crazy this was on the S&P 500. So that 10.5% day was the 3rd largest gain in the history of SPY. One of the market's largest ETFs tracks the S&P 500. That was the 3rd largest single day gain that we had ever seen for SPY. Now, if we do QQQ, we can see a very similar chart here with the percentage moves on QQQ. Even a little bit higher. I think this was about a 12% day on the Qs. That was the 4th largest move in QQQ history. Crazy, crazy moves that we were seeing there at the lows.
Yep.
I want to talk to you because when I think about Dave Keller, when I think about your strengths, your expertise, one of the things that absolutely comes to mind is psychology.
Yeah.
Behavioral finance, really analyzing the emotions that are involved in trading and investing and analyzing what's happening in the markets.
Yeah.
How do you manage, what sort of tools are you using to manage your own psychology when you see swings like this? I mean, historic moves off the lows there that we had in April. How are you managing your own psychology?
Yeah, and that's the same stretch right there where the VIX is spiking to, some of its highest readings in history.
Yeah.
So, I mean, volatility is like in some ways the best thing about the markets because without volatility, charts really don't matter a whole lot, right? I mean, trends are developed through a course of volatility, right? So you need volatile periods for technical indicators, for swing trading. Any of that is driven by a volatile market. So low volatility is not as great as you think. That's actually can be equally frustrating.
Right.
That period in particular, I mean, that's right around the April low, was a challenging period. And I think what I've learned during periods like that, where there are significant swings, is there is a huge kind of recency bias that a lot of people struggle with, which is whatever has sort of initially happened, we assume that's going to happen forever.
Absolutely.
So when the market really rolls over and has these big down days like you saw in early April, people assume, all of a sudden start thinking the S&P is going to go to 2,000 or some ridiculously low level, which is theoretically possible but highly unlikely.
Right.
And so we're all very surprised by quick reversions to the upside. The 2025 low reminded me a lot of the great financial crisis, right, in that 2009 period, because I remember market, I think, bottomed out in March, and like April, May, we're still trying to figure out, like, was that the bottom?
Yeah.
And same thing, these huge moves all of a sudden, but a lot of major lows have been moments. I mean, they've been V bottoms where we accelerate, and then all of a sudden something happens. Someone gets involved. There's a big news event, and all of a sudden we revert very, very quickly. So if there's one thing I've learned in periods of volatility is it often is best to sort of take a step back, take a deep breath, and really think about what levels have been reached, right? What levels are we hitting, and having a structure of sorts with how you're approaching things. For me, certain times when I'm analyzing the daily chart of the S&P, I'm not putting a lot on there. I find like in that April period, I'm adding a lot of notes and lines and levels. I'm shading levels because I'm really just trying to think about what does this move mean in terms of context.
Yeah.
So that was a long rambling way of getting to my final point, which is when in doubt, zoom out. I think when things get very, very volatile, our tendency is to get drawn in to very, very short term. So we think of every blip as being very important. This is the time to zoom out, look at weekly charts, look at monthly charts, really think about what this move means in terms of context.
Yeah.
Because when you're really moving your daily chart aggressively because of the volatility, bring in more data, bring in more information, and then you can start to understand how does this move relate to all the other big corrective moves we've experienced over our careers.
Yeah.
There have been a lot of them, and so you can start to relate them to one another.
Yeah. I love that you're talking about, when in doubt, zoom out.
Yeah.
To me, that is absolutely sort of the way to handle a moment like this.
Yeah.
And specifically, if we kind of stick with the charts here for just a minute, if we pull up SPY on a longer term time frame, this is a 5-year chart of the S&P 500.
Yeah.
We can see that this wasn't that far off from basically a big retest of those kind of 21 and 23 highs that we saw.
Yeah.
If we look at QQQ, actually, we can see that this really was a retest of those highs.
Yep.
If you break out and you retest that level from the top, and then you bounce, that is about the most ideal technical setup that I can possibly find on a chart.
Yeah.
If this is happening on an individual chart, on an individual stock, I'd say, oh my God, this is an amazing buying opportunity. You see that kind of thing when you zoom out on the S&P 500, which is so hard to do in those moments because like you said, you're sucked into the short-term price action. Yeah. You're sucked into the madness of what's happening from day to day. But I think it's absolutely crucial to zoom out.
Yeah.
For me, that's one of the biggest lessons of these kind of moments is start messing with your time frame. It's great when times are sort of normal, when the VIX is low. It's great to have your sort of fixed time frame that you're watching the market through.
Yep.
But when the VIX spikes, when madness starts to happen, when you got sector rotation and breadth is falling off a cliff, everything is sort of blowing up. Starting to mess with your time frame and start to bring in more context, more perspective, I think is absolutely crucial. That was so helpful at those lows.
Yep.
And I think for those of us who did that, the market became a lot more clear.
Yeah. Starts to make sense.
Especially in the context of, like we were saying, huge year in 23, huge year in 24, and when you see this kind of breakout retest bounce start to form, after those huge years, it started to make a little more sense, and you start to feel a little bit better. I mean, as crazy as that sell-off was, you start to feel a little bit better when you zoom out and you see that kind of longer-term structure set up.
Yeah.
I think that's absolutely crucial.
It's funny. I mean, the other thing I think you want to remember is getting to multiple time frames, right?
Yeah.
When the short-term time frame gets very volatile, when we're having these big tactical swings. Yeah. That's when I've learned, going back to like major bearish corrections in my career, going back to like 2000, like the, 9/11 into the 2002 low kind of thing. Yeah. You have to remember that two things I would say is number one, over the long term, remember the general trend in equities is higher, right? So every time you have a big downdraft, remember that is contrary to the general trend, right? So that's not going to last forever. So it feels like it's going to go down forever, and we know it's not. Right. Because the market has literally retraced 100% of every correction in history. Yeah. So that's one thing. So I think the second thing is you really want to think like a contrarian when we're in those aggressive sell-offs. Yeah. Walter Deemer, who, famous technical analyst at Putnam in the 1970s, when the time to buy is when you won't want to, right? When you can't imagine taking on risk in your portfolio because of how bad things look. Yep. Buy when there's blood in the streets, right? Exactly. Buy when things get negative. So it's really hard. Now, I'll tell you, we know this from earlier this year. It's really hard during a big negative rotation to be super bulled up. Yeah. But what you want to start remembering is that if your runway is long enough, that's usually going to present a really ideal buying opportunity. Yeah. So just recognizing that volatility is probably short-lived, that spikes in the VIX have always come back down, and the VIX gets down to the teens, which is where it is today. Yeah. It's going to mean revert. And so having a long enough time frame in mind, not getting drawn into the short-term volatility, but understanding what that means for the long term, I think helps you get through that too. Yeah.
Something I've been thinking a lot about this year too is kind of the language of the market. The reality is that everyone is speaking a different language. If everyone was speaking French and German and Japanese and English and all that stuff and trying to communicate with each other, we'd go, I don't speak your language, so we can't have a conversation here.
Yeah.
In the market though, everyone is speaking a different language called time frame. But they all sound the same. Everyone's speaking English, but they're talking time frame.
Yes.
And the reality is that when you're talking to an incredibly short-term trader and you are an ultra long-term investor, you are speaking dramatically different languages.
Yes.
And when you're seeing headlines that are sort of speaking that different language because they're talking a different time frame, that is crucial. And I think a lot of people lose sight of that. Again, because we got all these headlines, we've got all this panic, we've got all this concern. But the reality is you have to figure out what language you're speaking and then use that as sort of the context for the decisions that you're making and the analysis that you have.
I love that.
You talk to a lot of different investors in particular, especially with your show.
Yes.
That must be a challenge, talking
100%.
different
and I would say it's very easy to kind of fall victim to mission creep, where it's like you forget what you're actually trying to do.
Right.
And all of a sudden you get drawn into a very short-term, a very long-term time frame, right?
Yeah.
And I think staying true to your investment goals, your investment horizon is super important.
Yeah.
One of the ways that I've helped people kind of get through that is really an exercise I've done with money managers for years, which is write your one pager, sort of your investment justification, right? On one page, work up, here's what I'm trying to do, here's how I'm going to do it, here's how I'm going to find new ideas, here's how I'm going to manage risk, and you lay it all out ahead of time. And for anyone watching, I challenge you to kind of just work up that one-page document because just the process of doing it, you will know immediately where there's a weakness, right?
Yeah.
And a lot of times it's like, oh crap, what is my risk man? I really don't have a very well-defined, if you can't write it out, it's not well articulated, right? How are you identifying new ideas? Because what happens is, in a volatile, uncertain period, you'll get drawn into the squirrel effect. Like whatever pops up, you're like, oh, that's it, okay, great. And as opposed to using ideas and what someone says as an opportunity for you to take it back to your process and say, okay, does this check all my boxes? Does this fit in with my goals? It does. Okay, great, I'm gonna add it. So I encourage people from money managers to financial advisors to individual investors, if you're running your own portfolio, lay it out very clearly.
And write it down.
Write it down. It can't just be up here.
Yeah,
exactly. It has to be articulated. It has to be laid out. Because that process, and ideally, I would say, call up a buddy, call up your mother, somebody, and explain to them, here's what you're doing, because that's the other test. That'll force you to have some accountability.
Yeah.
But I think laying out is really important, because what that does is it helps you not fall victim to what it's so easy to struggle with in this kind of environment, which is you get completely distracted from what you're trying to do, and you let certain market movements, take your attention away from a process that you want to stick to. So hopefully something we can all think about going forward.
Yeah. I think also when a lot of people hear this conversation about, time frame, figure out what your time frame is.
Yeah.
It's okay to have multiple time frames.
For sure.
For me as an investor, I've got basically different buckets to my portfolio that I've got little nicknames for them and things like that. But realistically, they're long-term, intermediate term, and short-term buckets. Yes. And so the sort of area that I'm going to focus on changes depending on what the market's doing. When the market sells off aggressively and we're 25% off the highs, well, I'm not focused on short-term trades because everything is a complete mess. But as far as long-term opportunities to allocate some capital, that long-term bucket becomes much more important for me.
Yes.
That's where I'm going to focus. So it's okay to have multiple timeframes. I think people also get kind of locked into thinking, I've got to be a short-term swing trader or I've got to be an SPY buyer for the long term and I can't do anything else.
Yeah.
It's okay to have these multiple time frames. You can speak multiple languages, you can trade multiple time frames.
Yeah.
But you got to be sort of in tune with those. And I love what you're saying. Write it down, have that kind of one pager. That makes a lot of sense.
Yeah, and I think that's a really good point, because I had that just recently where I was talking about a stock and talking about how it was rolling over in the short term. And then at the end, I was like, full disclosure, I do have a position in this name, which is standard operating procedure when you're talking about things. And so someone kind of called me out on about it. Hold on, if the chart doesn't look good, why would you own it? And I was like, well, that's in the portfolio over here, where my goal is to have very low turnover, to pick some things that I think are going to work 5 to 10 years from now, which means I shouldn't be worrying that much about this little 1 to 2 week thing. But if it was my swing trading account, I would have 100% been out, and here's why I would have done it. And I think, but for me, that speaks to your point, which is you could and arguably should have some different buckets that have different goals. And just think about what is that portfolio, what's the goal, what's my process. And that means you can have two very different accounts doing different things, and just make sure you're not crossing the streams too much between, like, stay true to those disciplines. And I think that's where you're going to stay out of trouble.
Writing it down really helps.
100%.
I want to ask you about your market model, your Keller market trend models. That's something that we've integrated in a couple of places around StockCharts, specifically on our new market summary dashboard. We can jump over to StockCharts really quick. We'll pull that up. Here's the market summary dashboard if we got me up on the screen. And as we scroll down here, we can see the Keller market models, two different models, the macro model and the stocks model. I would love to get your thoughts. I mean, I love using this for myself, and I've been using it for a long time since we integrated it on the dashboard, now on the market summary dashboard as well. How has this helped you navigate through this year? We've seen these arrows shift around quite a bit.
Yes. And first off, thanks again so much for featuring this as part of the new market summary page. The new market summary page, I'm a huge fan. You showed me an early version of this, which I loved, and you've made some really good incremental improvements to it too.
Great stuff in there.
This was a thing that I think StockCharts really needed, and it's a great structured way of making sense, kind of macro to micro. I think it's a brilliant part of the website. So.
Thank you.
Congrats again on that. It's a great spot to have people start. I think their use of StockCharts. The market model for me, it came from years ago when I was looking at the markets all the time, and I found I was always going back to a weekly chart of the S&P and just kind of asking myself three questions, like, what's the long-term, like, secular trend? What's the medium term, what I'd call, like, the cyclical trend? And then what's the short term, what's the tactical trend? And I found I was just doing the same thing every time. I was just trying to answer those questions because there would be short-term changes, and I just wanted to remember, going back to what we talked about, is that just a little blip, or is this a bigger change? And that's what I was trying to get to. So I set up a chart with a series of exponential moving averages on the weekly data that just quantified and systematized what I'd been doing subjectively for years, which is just quick calculation. What's the long-term trend? What's the medium-term trend? What's the short-term trend? And I started, doing that analysis every Friday after the close. I'd update this chart, and I started telling people about it, and that became the start of, market misbehavior. My own service was just kind of using that as a lens of describing what was happening in the markets. Because I found, for me, a lot of times when investors get into trouble, it's not because they're using tools wrong. It's not because their analysis isn't good. They're just ignoring very clear signs the market's providing back to it. Like, they're just not paying attention to things. And so for me, this model just helped me at any point. What are the with these different time frames, what's the trend? So the market trend model over the year has actually been really, really helpful because the long-term model has been bullish since the beginning of 2023. So that tells you the secular trend in this market has been remarkably strong, which I think is kind of fair, with some significant drawdowns along the way. But overall, I think the long-term trend has still been pretty healthy. The medium-term trend for me, which is more of that cyclical time frame, that's how I really want to be positioned. It is super important because that tells me when I want to be adding risk or taking risk out of the portfolio. What I always say, whether it wants me to focus on capital growth or capital preservation. And there was a period off of the February peak when the medium-term trend model turned bearish after the short-term model had turned bearish. And that told me, okay, by mid-March, we're definitely risk off. I want to be taking bets off. I want to be unwinding. I just want to focus on preserving what I have and just focusing on that. And then coming off of the April low, I mean, if there's one thing that I have always struggled with, it's going back to bullish after the market's been really negative, which was really, really tough. So that model eventually turned, bullish beginning of May as the S&P kind of gapped higher. And I remember that Friday when I looked and the medium-term model had finally turned bullish. And I'm like, all right, I cannot with a straight face tell people that I'm not bullish. This is not bullish price action. It just is. By definition, the market's gone up enough. And for me, that's helped me just ride the remainder of this uptrend up to new all-time highs again this week. So for me, it takes some of the guesswork out of trend analysis it gives me a really good starting point, and it's literally the first chart I look at every morning, which is what's the trend? Okay, everything else I do after this moment is with that as a framework of just thinking about the trend. So at this point, it's bullish on all time frames, and it's a great reminder of as long as that's true, and as long as those arrows are all green, I shouldn't be that concerned about the trend in the market. The trend's overall pretty strong.
Yeah. I think that this is a fantastic part of that market summary dashboard because I mean there is a lot of data here. We've packed a lot of things onto this page. It's really, really helpful. But I think especially if you're kind of new to this page, new to the markets, if you're trying to figure out how you feel about the markets, that is an incredible place to turn. Because if all of those arrows are pointing up and you still feel like the market is just absolutely in the trash can, well, you should probably check that. You know, it's going to tell you something. And if you're trying to digest all of the data, all the information that's on this page, this is a great place to turn to and say, okay, I think this, but how does the market model feel? How do we know what's the market model telling me? And if it's if it's all pointing green like it is right now, it tells you a lot. It's kind of an easy way to digest the markets. I think it's been helpful for me, through these different cycles, through these different phases this year, especially with that short term, just absolutely chopping around like it has been. But yeah, I love seeing your work on that thing, and love seeing it on StockCharts. That's for sure.
Yeah, no, and it's good. And I think what the market summary page kind of illustrates is that when you're thinking about the markets, there's a lot of different inputs you're kind of combining to just get a good assessment of market conditions. So I think for me, the market trend model is the start, but then there's all these other steps you want to follow, which is, all right, what kind of stocks are leading, right? If the market trend model is bullish, well, which sectors and themes and types of names are performing better than average and which ones are lagging behind? What are the breadth conditions? Is this a broad advance or a narrow advance? That at times has been really helpful in terms of helping you understand leadership. And I think that lays out really good measures of trend, breadth, and sentiment that I hope give people an opportunity to drill in a little further to continue that analysis.
Yeah, we talk about it a lot as technicians, right? We talk about looking at all these different corners of the market, putting it all kind of in one place for folks. I think it's been really helpful. Dave, I asked you to bring one chart that stands out to you from the first half of the year, something that's just burned in your brain. It's really stuck with you. I want to pull up your one chart from this first half of the year.
Ooh, I love it. So I tell you what I'm going to do. I'm actually going to build it real time, if that's okay.
I love it even more.
Here we go. So I'm going to use the power of StockCharts here. I'm going to go with a basic chart. So what I have found is for me. You want to think about market structure, and you want to think about it like a stoplight. Particularly when in the first half of this year, we had a big sell-off into the April low, and then at that bounce off of the April low, big question mark into when you take on risk, when you believe that it's enough of a move. What would you need to see to turn really bullish? And I feel like a lot of times people go into a very it ends up being an emotional decision, right? We kind of get away from our process and just it's more wishful thinking that's defining our entry points. And this is where I think you really want to lay in and think structurally. So I go with the stoplight approach, and I should point out that StockCharts ACP actually has a stoplight indicator that does this beautifully, which I would encourage people to check out. I kind of go old school because this is a trick that Arthur Hill showed me a long time ago, which was basically lay things out using rectangles. So literally on the stock chart, on the Sharp Charts workbench, you use the annotations. I use a series of rectangles. I use different colors. And I remember coming off of that April low when we had that initial rally. I remember looking to the left on the chart, and I'm just generalizing here for for time. But at the time, I went serious about it, and I really set things up in a very structured way. And what I basically did said, all right, off of this low, if we do have this V bottom, which we did, like at what point would I really start to believe that, okay, I can't ignore that that's not just an initial bounce, that's the beginning of something more significant. So below there, I kind of went with, all right, if there's anything below like 5,500, I think that's a red light. And particularly up here, I'm like, all right, this is a good rally. This is an impressive rally. But if we break below 5,500, I think we're back in the red light category, which means I probably want to be pretty risk off. I want to just be defensively positioned because we can't get to 4,500 without breaking below 5,500 first. So below there is where I'm probably super defensive. Between like 5,500, 5,800, and this is looking back to like the swing high from late March, ended up being a big gap higher in early May. It was like, all right, above 5,800, I better be fully invested because I feel like that's enough evidence that the market's in a strong uptrend, and I want to make sure I'm allocated and benefiting from that. And then between those two, I think it's a yellow light. I think it's like a, sit on your hands, wait and see, and unclear. So I probably want to be more neutral in an allocation. And for me, like I had this chart, I looked at it every day on my market recap show. We looked at this chart. It was like, all right, which light? We're in a green light still. Okay, that means we're constructive. And it helped me during like this period right here. I remember vividly the market coming down kind of that third week in May.
Yeah.
But just keeping an eye on, all right, what I said was as long as we kind of hold 5,800, it's still a green light. So it was still a green light, conditions were good. And for me, it was a great reminder of in any environment, you probably can create that sort of structure of above this level, we're great. Between these two levels, we're okay. Below this level, we're pretty bad.
Yeah.
And so for me, kind of thinking of an allocation like a stoplight was super valuable and just helped me recognize short-term moves were just short-term moves. And for me, this is sort of that medium-term time frame that made sense. If you're more of a short-term trader, you could do this on a much shorter-term time frame and just think about where you'd want to take on risk. And for me, it's helped me. This kind of approach and the indicator on ACP is what I really found helpful with individual stocks. Really above this level, I probably want to be long. Below that level, I definitely want to be out. In the middle here, maybe I'm looking for opportunities. And so for me, this is in some ways looking back, I think this will define at least the first half of 2025 for me. And navigating off of that low was just setting up these levels and then following them when they're broken.
Yeah. We've showed this to a lot of people. We always get questions on it. I'm thinking as you're sitting here talking, a good friend of ours, Brian Shannon of Alpha Trends, one of the things I always hear Brian saying is innocent until proven guilty versus guilty until proven innocent.
Yes.
So if you think about these kind of three zones on the chart, right? You've got at the top, if it's in the green, people are always asking us kind of the interpretation. What am I supposed to do with these three zones? If it's in the top box, it's that the market, whatever stock you're looking at, whatever you've drawn your lines on, is innocent until proven guilty. Things are pretty good, right? If it's in the neutral zone, it's more guilty until proven innocent. And if it's in the red zone, it's just guilty. Market's ugly. Things are guilty. Things are bad. Right? But it's such a fantastic way to think about that. Not just the market, but any individual stock, drawing these levels, trying to simplify your analysis. Every time I see this, every time I use that indicator in ACP, like you mentioned, we call it the traffic light over there. But it always takes me back to first learning technical analysis. My dad was a stock trader, so he grew up teaching me, just like Henry in your office, pointing out stuff on charts. I grew up learning technical analysis with a big pink highlighter, drawing trend lines on really, really simple charts. And it was such a clear sort of lesson to learn. Stuff can go up, it can go down, it can go sideways. It really can't do anything other than that. This is kind of another example of that. Simplify your analysis. Treat yourself as if you're an elementary school kid learning technical analysis. Having these three zones on any chart is such a beautifully simple way to think about the markets. I always love this traffic light, stoplight kind of tool. And really such a great way to think about this year. I love that you brought this up. It's incredible how powerful that visual is.
And where I have struggled, and I think many people do, is just gaining confidence. Like when the market initially rallies off the low, it's totally normal to be skeptical. And I was arguably very vocally skeptical in like mid-April. Like there's no way this can just go back to the previous highs. Like we've got to keep going lower. But it's like, at what point are you going to recognize that the market is strong enough that you are forced to change your perspective? And I think by laying it out in this structured way, it's less guesswork, it's less emotional, and it's less reacting to the price action that you're observing. That's why it's so valuable.
It's the same thing for me as putting your stops down on the chart as opposed to saying My stop theoretically would be at 105.
Yeah.
It's different if you actually put a line on the chart and you go, this is my stop. I've entered it with the broker. Yeah. I got it on the chart. I know it's here. Yes. It's objective.
Yeah.
This is a good version of it.
My approach with this is to use alerts. And so when I set up this stop light originally, I started setting up alerts in StockCharts. All right, when it gets above this level, like send me a text on my phone, green light.
Yeah, exactly.
And I remember when that pops up, I'm like, okay, all right, market's bullish, right? I can't deny it. This is a constructive market. So good lessons learned there.
Yeah. So my one chart that just absolutely will forever stick with me, burned into my brain. We're looking at it's funny, we're talking about, the importance of zooming out. Now we're going to do the exact opposite. We're going to zoom way into the April lows.
Yeah.
We can see the V-bottom structure right on this chart. This is it. We're looking at it. And I mentioned these 3 candles that are absolutely burned in my brain. This is that, again, turn on the inspect tool if you're not familiar with this on StockCharts. Make sure that you got this little box checked. You'll see the chart actually kind of flashes. That little box, though, allows you to sort of really see exactly what's happening on the chart with this kind of interactive hover feature. And as you're going to see in just a second, it also allows you to measure things on the chart. So here's our 10.5% up day on the S&P 500. Huge, huge day. But what actually sticks out to me, what is so just stuck with me and forever will be, is 2 days before here. So this is April 7th. I'm still convinced that the White House sort of floated the idea of the tariff pause out there, put it out into the ether and said, no, we're not taking credit for that. We don't know where that came from. We're just really happy that it happened so that we could see exactly what was going to happen with the market if we do pause. And then 2 days later, sure enough, they pause. Yep. We saw this crazy, crazy reaction, though. If we actually measure that, so off the lows, that was about an 8.5% intraday move on April 7th. Just absolute flyer of a day. And it happened just at the drop of a hat. We got the sort of news speculation of a tariff pause. And in an instant, the S&P 500 rallied 8.5%. Yep. I'm convinced that set the stage for the actual tariff pause on the 9th when we saw such a huge, huge day. But this just is stuck with me. Absolutely stuck with me, those 3 candles. Crazy price action. We looked at it in a couple of different ways, zooming out, looking at how historic that was using the rate of change indicator. Yep. But just absolute madness that we saw. It just stands out to me.
It's a crazy reversal period. And then what's interesting is after that initial, sort of rotation and for candlestick aficionados, just this beautiful bullish engulfing pattern that happened on that day.
Biggest one ever.
But if you look at like the next couple weeks, we then made a higher low sort of late April, and then we broke above the high of that 2-bar pattern, right? Yeah. We finally broke out. And so when you look back at it, I mean, even though it was noisy and it was volatile, it did follow some of the kind of basic foundational concepts of technical analysis. It's a big percentage swing, but the concept still held pretty well. And so again, going back to like the contrarian hat, I mean, when you have a big sell-off, you look for signs of capitulation, you look for signs of downside exhaustion, you look for signs of accumulation that buyers are coming in. And I think that's what you saw during that week, kind of April 7th, 8th, and 9th. You saw clear signs of people buying into weakness. Yeah. And that set the stage for a pretty sustainable advance into May, June, and now into July for sure.
I mean, look at this off the March closing lows. So draw that horizontal line. Yeah. I think this is such an important representation of the fact that markets are supply and demand. We love to forget that. We love to forget that we're not an Econ 101 class, but if we talk to our Econ 101 professor, right, they're going to tell you about supply and demand. It's the first thing you learn when you take an econ class. Yeah. Markets are supply and demand. This is such a great way to visualize it. You look at how we traded, around those March lows. You look at then what the reaction on that April 9th day was, brought us right back up to those March lows, and then sort of testing it, later in April. I think zooming in like this and kind of seeing the supply and demand with those candlesticks on, super simple chart, nothing else on it, no indicators to get in the way. That's definitely my sort of one chart for the first half of the year.
I love that.
Stuck with me.
Yeah.
I also asked you to bring one chart for the second half of the year, something that you're focused on, something that's sort of really, really top of mind for you.
Yes.
So I want to jump over to that now. What do you got?
So my chart is actually the seasonality.
Well done. Well done.
Because I think this is where we need to focus, right? Seasonality is at times super important. At times does not feel super important. So I don't bring this up all the time. but when I feel like it's going to be, it kind of resonates, right? And so if you think about the normal kind of 12-month calendar year, Jeff Hirsch, who's been on StockCharts TV a number of times, many others have done some really good work with seasonality. But the idea, there's this normal pattern to the months. Sell in May and go away, commonly referred to sort of market maxim related to that normal 12-month cycle. So there are a number of ways you can look at seasonality. I would think of it in a couple ways. Number one, look at what's happened since the COVID low, because I think kind of starting in 2019 into 2020, we're kind of in this kind of newest era in financial history. But you can also look at it in terms of post-election years, which is where we're in now, because a lot of times the 4-year cycle kind of has a certain resonance to it. So, year one of a new administration looks similar to previous year ones. In either case, so here we're looking at the seasonality in the S&P, just going back to the COVID peak. So like 2020 through the end of last year, what's happened during some of these months. And what you'll find is after the market bottomed out in April, the strength that we've seen in May, June, and July actually follows the pretty consistent seasonal pattern we've seen post-COVID, which is May, June, July actually tend to be quite strong. Going back over time, it's not as strong. And actually, we used to often talk about the summer doldrums. Kind of June into July was when the market kind of was sleepy and weak, and then would usually sell off into a fall low. It's started to evolve where the summers have actually been a little stronger than historically average. So if you look every year for the last 5 years, July's been positive. Certainly looks for now like 2025, pretty strong July. That's after June and May have usually been pretty strong. That's what we found this year. But if you look now to the next couple of pieces of the histogram, you'll find it really starts to change. So what has not changed pre-COVID, post-COVID, post-election years is the fact that August into September is usually pretty weak. We often, if not almost always, have a major low in September and October. There have been years where that hasn't happened, but those are hard to find. The average year kind of follows this pattern. So given the fact that we've had the incredible rally that we've had, given the fact that technology has dominated so much, arguably going to incredibly hard to justify valuations, we also happen to be going into when the market often sells off.
We're setting up pretty beautifully for a sell-off here.
I mean, I don't know. I mean, neither of us can write the script for the markets, but it would make sense to me that we have strength in the summer going into late summer, early fall with a pretty significant drawdown. And that sets us up for strength in Q4, which is almost always a period of strength. November is usually one of the strongest months. So looking forward, I think the strength that we've had in the last three months off the major low, the seasonality, I think this chart is probably going to become a pretty important playbook to keep in mind. And it tells me with the market trend model, with signs of breadth and momentum, look for these signs of a rotation. For leadership, look for technology that has been so dominant. Look for some question marks on those themes, because most likely you get a major pullback into the fall.
And I think the key with that pullback is that even if you are bullish, no matter how bullish you are, I think the healthiest, most bullish thing that this market can do is sell off. We've gone too far. No matter how bullish you are, you don't want to see the S&P 500 close above its 20-day moving average 60, 70, 80 sessions in a row. That's not sustainable. And the further that goes, the more aggressive that sell-off, I would say, has to be. So setting up for a sell-off here into August and into September, I think is a healthy thing for the market to do. Maybe even retest those highs. This is a great way to see it though with the seasonality.
And you hinted at. I mean, not to get non-technical briefly. I mean, I think going into sort of the initial talk about tariffs, which is kind of like mid-March, like late March, early April, is when we had that big sell-off. It's like tariffs are out. Okay, this is going to be a disaster. But then immediately it was, nope, we're pushing it down the road. It was sort of like a holding off, and the market's rallied. Now the market has gone well above the point it was when tariffs were originally announced. They may not be as disastrous as some maybe would expect, but they're good. They're a thing, right? They are going to make
We're seeing that with the GM headlines right now.
So I think, and we're just in the earnings quarter where we're starting to hear companies, start to address those impacts. So Walmart, the market has been pricing in like glass all full, not even glass half full, but like glass all full, Goldilocks scenario.
Running over.
And it's not going to be that perfect. Like there are going to be issues, and we don't know what they're going to be. But the market has basically priced in perfection, which means you're kind of setting up for that point where we all realize, okay, there's this issue we haven't fully priced in. There's this question mark, which is going to cause. So I think we're even setting up on a macroeconomic side in which it makes sense to line up with that seasonality as well. So that's another a key factor.
Healthy markets move higher in a series of rallies and reactions. It's not healthy markets go higher always indefinitely, and everyone buys Bitcoin. It's rallies and reactions. I think we're seeing that this year. We need those reactions to keep this bull market healthy.
Yeah, and pullbacks. I mean, pullbacks are quite normal, right?
Yeah.
And even in very bullish years, you do often have multiple pullbacks. Yeah. You often have one significant correction, and over multiple years, you'll have a really painful correction. I mean, that's market history is full of that.
Yeah.
And even if the long-term trend is quite good, and even if 2025 still ends up being a very strong year, there is room for a lot of drawdowns. And I would just be happier not participating in the entirety of a drawdown coming forward. So I'm happy remaining vigilant as we're at new highs here.
And I think the seasonality chart just provides some context for you. If you're riding through that sell-off, this is a great way to think about it. It's not some completely abnormal thing to sell off in September. If we do see that in a market that actually needs it, this provides a little bit of context for you for sort of why that's happening. Maybe just helps you feel more comfortable with that move, right?
Yeah. Yep. Agreed.
My one chart, we're going to wrap up here pretty soon, but my one chart for the back half of the year has got to be small caps.
Okay.
So I think it's a broader theme of just kind of interest rate sensitive sectors, interest rate sensitive indexes and groups and all of that stuff. Obviously, there's so much talk right now about the Fed. So much talk about a cut in rates, how that's going to impact things like small caps, things like industrial, so many different things. But to me, small caps for the last couple of years have been this incredible coiled spring. A lot of people talking about the underperformance in small caps. I don't think enough people talking about the consolidation in small caps. Those are two sides of the same coin, you could say. Yes, small caps have dramatically underperformed. We can see that. This is a 5-year chart, so we can see that up here, heavily underperforming the large cap indexes and doing so for multiple years here. But also consolidating in one of the most clear-cut ranges that you can possibly draw on a chart. And now actually kind of pushing towards the top of that range here. We're looking at the S&P 600.
Okay.
I'm watching small caps really, really closely. And specifically, I'm kind of cheating here because I got a couple of charts here as my one chart, but oh well. I've got the small caps versus large caps ratio here at the top, SPSM versus SPY. And I've also added, because I can't stop cheating, the mid caps, S&P 400 versus the S&P 500. I'm watching both of these ratios really, really closely. I think if we do see a drop in rates, if we do see a change in the Fed stance, I think that's going to help things like home builders. It's going to help small caps overall. This is definitely a corner of the markets that I'm keeping a close eye on. And I think it also can tell you something about risk appetite too. If we start to see small caps getting that pickup, we can do this through growth versus value, technology leading versus lagging, different things. So many different ways to think about risk on versus risk off. But to me, I'm looking for that change in rates, and I'm looking for small caps to resume some of that move higher. Hopefully claw back a little bit of that underperformance that they've suffered from in the last few years. But I think this is definitely an area of the markets that I'm watching for the last half of the year.
Really good series of air quotes one charts. I think, but I think those are all really good points. Small caps have been chronic underperformers. A big part of that is just the structure of the benchmarks, right? So our large cap benchmarks are very growth heavy, very technology, Nvidia, Microsoft kind of indexes. Small caps a lot more nuanced. Things like industrials, regional banks, healthcare are much bigger represented in small caps. So as we've had a year, and certainly off the April lows, where the market's been dominated by growth, and we're kind of back to the Mag 7 leadership, large caps have been outperforming. It's not going to go on forever, and at some point, we'll start to see rotation. I think these ratios are really good ways of recognizing leadership rotation. I think Julius DeKempener's RRG charts are another really good way of recognizing that, because technology is kind of an outlier right now, looking so good while other things are struggling. Industrials kind of get up there as well. But you start to see a rotation. I think that's going to be there are always clear signs after a big move that there was rotation. And I think getting ahead of that and just thinking about what charts you want to focus on to help you understand that the narrative is shifting, super valuable. I think that's a really good selection as well.
Yeah. We'll point out one thing from our market summary dashboard because we got to keep highlighting the value of this tool. I absolutely love it. One of the things that we've built in here is key ratios. There's a panel on this page called key ratios. Allows you to flip between a couple of different sort of flavors, if you will. So we've got a size flavor here with mega caps versus large caps, mid, small, and micro caps versus large caps. And this actually is going to be sort of changed. The data on this is going to change depending on the time frame that you select in the top left corner. So if you want to see how those ratios have moved year to date, for instance, you can select year to date in that menu up in the top left, and you can see what has outperformed, what has underperformed. Actually pretty interesting to see mega caps underperforming. So large caps outperforming absolutely everything, the S&P 500 overall. Obviously, mega caps are kind of a subset of those large caps. So interesting to track that. You can also get a sense of offense versus defense. We're talking about risk on versus risk off, and some other US factors as well, growth versus value, high beta versus low vol. All of these, you can click them to get a chart. So if you want to see, for instance, that small caps versus large caps chart that I just pulled up, give that a click. That's going to take you right over to that chart. So you don't actually even have to create this stuff for yourself. So much there. And finally, scroll all the way to the bottom of this page, that ChartPack that we mentioned, you can actually access that right from here. So if you want all these charts installed in your own StockCharts account, this is how you can do it. Simply install that ChartPack. It's free if you're a StockCharts member. You're going to get, I think it's 30, it might even be up to 31 lists full of charts just like this, installed in your own account. Right in one click. It is a real game changer if you're a StockCharts member. So make sure you check that out. Dave, this has been a blast. I had more questions, but we got to cut it off because otherwise we're going to be here for 7 hours. And it's your market's about to close. I got to eat lunch. Yeah. But thank you so much for sitting down with me. It
was awesome.
It's always fun to pick your brain. Always fun to hear your perspective. So many different things to learn and to think about. Talking to you, it's always great.
No, it was a pleasure. Thanks, Grayson. Yeah. And this was fun. Years like this, every year there's something to learn, but I feel like years like this, it's a really important year to, at some point, really reflect on key moments, key lessons learned, and that's what's going to help you, be prepared for the next time. Yeah.
We're going to get you back in the studio, plenty of times before the end of the year, but I think we're going to have to run this back at the end of the year. We'll do another show. Kind of similar. Yeah. Let's run it back for all of 2025 and 2026. I can't believe it's almost going to be 2026. Yeah. It's crazy. My daughter's almost about to turn 1. I can't believe it. I feel like I just got back from paternity leave. Yeah. Crazy how time flies, especially when you have a market like this. But viewers, I want to thank you all for joining us today. Just been an absolute blast to be here with Dave Keller, Chief Strategist at Market Misbehavior. Of course, you can find Dave on StockCharts, on StockCharts TV, also at his own website, on X, just pretty much everywhere. Tune into Dave's Market Misbehavior podcast as well. I've been really enjoying seeing the guests that he's bringing on that show. So always fun to see who Dave is talking to. But want to thank you guys so much for tuning in. Again, remember, subscribe to the channel, give this video a like, that helps us out. And most importantly, don't forget, we've got a big sale going on at StockCharts right now. So all these tools, all these charts, the ChartPack, all the data, all the stuff we've been talking about today on the show, you can get all of that if you are a StockCharts member. Right now, you can sign up at a discount. We're running our summer sale up to 20% off if you sign up right now. So if you're a current StockCharts member, make sure you do that. Lock in a discount on the subscription that you already have. But if you're not currently a StockCharts member, you want to get access to all this great stuff on the platform, sign up for your free 1-month trial right now, then go sign up for the sale. So you get a free month and you'll get that 20% off. You get even more of a discount. So visit StockCharts.com. Make sure you sign up for those advanced premium tools and features on the StockCharts platform. As always, though, I want to thank you again for tuning in. We will see you again very soon for another edition. But until then, keep calm and chart on, my friends.